here in the New York Stock Exchange. I want to welcome in our next guest. We've got Joe Schmidt, CEO of Peak Retirement Planning, joining us. Joe, thank you so much for joining us this afternoon. Let's talk about where we are with trade policy. We're hearing from Treasury Secretary Scott Bessent about deals and potential deals. We have growing optimism around trade deals that could potentially happen. At the same time, we still have these tensions with China. How do you parse through all of that and decipher these cross currents when it comes to investor sentiment? What's your thoughts?
Yeah, I mean, there's so much going on right now, and this is a big one. And whenever we think about with our clients, I mean, there's a lot of people that are worried right now with a lot of what's going on and uncertain what's going on. But we always want to zoom out during times like this. I mean, the market going up and down is going to happen every year. You know, even the last 2 years, we've seen 20+% returns, but there's still drawdowns of 5, 7, 8% during those 2 years. And so we just have to get used to this amount of volatility. But, you know, if a lot of these things can get shored up, then it's going to be good long term, is obviously the hope. But what we tell our clients is just diversification, making sure we have a plan in place. And, you know, a lot of people may want to consider more of a bucket type planning strategy. A lot of people may have heard of that if you're going to need income from your investments, you may not want to be in the stock market right now. There's a lot of volatility right now. Maybe we look at more protected vehicles, which right now can get pretty reasonable rates of return, anywhere 4 to 5%, you know, without having to worry about the risk associated with the markets that we're seeing right now. So just understanding where you're at. If you're younger and you've got a longer time horizon, we can deal with some of these ups and downs. But if we're in retirement or near it, then maybe we need to look at protecting some of it, but also just making sure we don't have all of our investments all in one place. You know, never put all your eggs in one basket, as we've always heard.
Understood, totally. So let's talk a little bit about your bucket approach. You talked about I guess it's a protect bucket. What else is there? I believe there's a growth bucket. How do you delineate this?
Yeah, absolutely. So it's all about time horizon typically in most cases. It's also going to depend on risk tolerance. It's going to depend on income needs. And so based on all of that, it is then going to help people decide of what they want to look at there. And this is one of the bigger ways to do income planning for those in or near retirement as well. And so something that we look at with the clients we work with is, you know, hey, on a scale of 0 to 100, what's your risk tolerance? Are you going to be more worried if the market goes down? Or are you going to be okay with dealing with those ups and downs, knowing that could lead to more potential earnings over time? But also, if someone's going to need, you know, $50,000 of income from their investments every year, or $30,000 or whatever it may be, well, if they take out from a down market, then you have 1 loss from the market going down and then 2 losses from taking out money. And so that's going to be a double loss, and it's going to be a matter of, do we have enough time for that to come back up? So a lot of times people will say about 5 to 10 years of income, make sure that's protected. But especially, you know, 3 to 5 years is kind of the cycle of a downturn in the market, of what it could take to get back up to where it was. And so that could be something to buy you time so you don't have to take out when the market's down from that growth bucket, could be the idea there.
So I want to ask you this question. I know there is obviously the view that for long-term investors, you don't want to time the market. I don't want to say view. That's not the word I'm looking for. But sometimes there is this temptation. What do you say to investors who are tempted to try and time the market?
Yeah, great question. I mean, because a lot of people think like it's an unknown time, maybe now a good time to get out. And that could be right. But to your point of when are we going to get back into the market? So time in the market, it takes 2 decisions to actually get it right. You have to know when to get out, and you have to know when to get back in. And a lot of people are going to miss either one of those. And we all saw not too long ago where we saw nearly 10% return in one day. Well, if we got out of the market the day before that, we missed 10% return, which has been the average over a yearly cycle over time. And so we missed what could have been an annual return of 10%. We basically were out of the market for an entire year when we only missed one day. And so that's the thing, is we always have to think long term whenever we're thinking about investing in the market. We don't want to make emotional decisions, and we don't want to make decisions where we don't have the data to back it up. And I think that's extremely important for investors to understand. And like even Vanguard, they did a study that a DIY investor, where emotions can come into play, versus working with a professional investment management team, working with that team could potentially do 1 to 3% better over time, just from rebalancing, following market trends, tax efficiency, proficiency in behavioral finance of making sure you understand those points about investing. So that's one thing we always advise people of is make sure you're working with a professional when it comes to investment management, but also make sure you're getting comprehensive help with your planning on taxes and healthcare and estate planning and making sure everything's working together there.
No, Joe, you make a great point about the timing thing because you have to time it right twice, when to get out and when to get in, because I know a story of this would be a person who would be considered an expert in these things and would know better, had timed the Great Recession well on the way out before, things ended up where they were. But the person then said to me, but I didn't time it right coming back in. This is a while ago. But let's talk a little bit about your views on economic data points, right? We've seen some strong economic data still, but you're watching for signs of potential deterioration because you say we haven't seen the effects of these tariffs. What are you looking for in terms of potential weakness?
Yeah, I mean, just staying alert on what the news is coming every day. But again, just reminding people that when we are thinking about how this is going to play a part in our specific investments or our specific plan is just, again, not making the emotional decisions because as we all see on the news, things can change one direction or the other very quickly. I mean, we all know a man in Washington Washington, D.C., who has a phone and he has Twitter on it and he can make a tweet or he can announce something and it can change the entire markets. It can cause the markets to go up 10% in one day just by one sense of communication. And so, that's really what we're on the lookout for is what are the things that are unknown that could pop up or really make an impact on the markets and our clients' plans as we plan moving forward here.
Yeah, you make a great point. All it takes is one tweet or post on Truth Social. All right, Joe Schmidt, CEO of Peak Retirement Planning. We appreciate your time today. Thank you, Joe.